Today, let's dive into a pressing issue in the financial world: the potential insolvency of major banks and their concealed losses. Additionally, we'll explore how these banks might be inflating NVIDIA's stock ahead of a possible market crash.
Hey,
Welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. The analyst Peruvian Bull recently tweeted that banks have no strategy to unwind the massive derivatives monster they've created. His tone implies sarcasm, suggesting he's not genuinely surprised by this revelation. According to a CNBC article, banking regulators have identified flaws in the resolution plans of 4 of the 8 largest American banks. The Federal Reserve and the FTD criticized the 2023 living wills of Citigroup, J.P. Morgan, Goldman Sachs, and Bank of America, specifically regarding their strategies for unwinding their enormous derivatives portfolios. Derivatives are complex financial instruments linked to stocks, bonds, currencies, or interest rates. We'll examine this article further, but it's worth noting the critical, unanswered questions raised by Kristen Shaughnessy on Twitter. Regulators are finally scrutinizing J.P. Morgan, Goldman Sachs, Citigroup, and Bank of America's trillions in derivatives, focusing on interest rate derivatives and total return swap contracts. An insightful bank examiner questioned how all 4 mega banks managed to be on the winning side of trades during the steepest interest rate hikes in 40 years. This raises the question: where are the corresponding losses? In every trade, there's a profit and a loss. If these banks profited from their massive derivatives contracts, someone else must have incurred significant losses. The absence of reported losses suggests they might be concealed. These banks hold hundreds of trillions of dollars in derivatives, yet the location of the losses remains a mystery. Perhaps these losses are hidden overseas. If so, how long before one of these banks collapses under the weight of these hidden losses? Another article I came across detailed the regulators' concerns. For instance, Citigroup failed to quickly unwind its contracts under different scenarios, as required. Every 2 years, the largest US banks must submit credible plans for unwinding in a crisis. The inability of these 4 banks to do so could spell disaster for the financial system. J.P. Morgan, Goldman Sachs, and Bank of America had shortcomings in their plans, but Citigroup's deficiencies were even more severe. This is alarming if these banks are hiding trillions in losses. The potential damage to the financial system could be catastrophic. Short sellers are more anxious than ever. Jim Chanos, a well-known short seller, has emphasized the need for more short sellers now. He's even targeting meme stocks like AMC and GameStop, highlighting the damage these stocks are causing to the market. Chanos' urgency suggests we might be nearing a market squeeze. He believes that by continuously buying and holding stocks, retail investors can crush short sellers by reducing the shares available for borrowing. Some might argue that we've been buying and holding AMC and GameStop for years without seeing a squeeze. However, this strategy is effective and happens daily with fast-moving momentum stocks. AMC and GameStop are unique due to the vast number of synthetic shorts. For instance, today, Mogo's stock surged from $4 to over $16 per share, a 400% gain in one day, trapping short sellers. This didn't happen with AMC or GameStop because of the enormous volume of synthetic shorts. Crushing shorts in these stocks requires much more buying pressure. When we saw significant price gains in GameStop, it was due to high trading volumes. For example, during peaks, we saw up to 279 million shares traded in a day, compared to the usual few million. Such volumes make it difficult for shorts to cope, leading to spiraling prices. If we see 1 billion shares traded in a day, it could destroy the shorts. Jim Cramer has also exposed the dirty tricks short sellers use to manipulate stock prices. According to Cramer, these illegal tactics go unnoticed by the SEC. Many believe banks are pumping NVIDIA stock ahead of a crash. Analysts are frequently raising price targets for NVIDIA, suggesting a strategy to inflate its value before a major sell-off. Despite articles claiming NVIDIA's valuation is compelling, it's likely that banks are preparing to offload their holdings at the peak before buying back at lower prices during a pullback. The current financial landscape is precarious. Major banks are under scrutiny for their resolution plans, raising concerns about their ability to manage their derivatives portfolios. The absence of reported losses on these derivatives suggests potential concealment, posing a significant risk to the financial system. Meanwhile, short sellers are becoming increasingly desperate, signaling a potential market squeeze. The situation with Nvidia's stock highlights the manipulative tactics of banks and analysts, further complicating the market dynamics. As retail investors, understanding these intricacies is crucial in navigating the turbulent financial waters ahead. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.